Mahesh Nandurkar is joining us now, Head of Research and MD at Jefferies. Mahesh, afternoon. Thank you so much for your time this morning. You may have, analyzed the fine print of the budget quite closely, I'm assuming. We went to the budget, with a very low set of expectation, this one being vote on account. But in general, the street has a habit of building expectations even when they don't warrant any. But it came out as a prudent kind of a budget, minus all the populism. From the street point of view, how much would you give this budget out of 10?
I think, first of all, I would say that this was an important budget. The word interim or the word vote on account is just a technical terms. But I think it's the budget to watch out for in my view, because what we've seen historically also is that, if you look at 2019 as an example, then there was hardly any difference between the interim budget numbers and the final budget, that was ultimately presented. And also, if one assumes that the same set of people will be presenting the next one, it would be very difficult to deviate from the February budget. So I never took this budget lightly. I always looked upon it as the budget. Maybe some small tweaks can happen here and there, but I think the broad pathway that would be set out in this budget would be the one that would continue post elections as well. So that's first point. The second point, as to how do I look at this budget, I think it was one of the best budgets, in the sense that, given the environment that we need to undergo fiscal consolidation, and I think the government did an excellent job on that. In fact, they they delivered numbers which were better than market expectations on the fiscal consolidation front. The market was expecting about 5.3, 5.4. And what they have targeted for the next year is actually 5.1, so much better than what market expectation was. And I think even more than the fiscal consolidation, what I find the single most important point from the budget is the balance between the expenditure growth. On the capex side, the growth is almost 16-17% on a year-on-year basis. And on the non-capex side, if you exclude interest payments, is actually a decline of 1%. So clearly the government has told us the direction in which they want to move. And in a pre-election budget like this, the split is plus 17% for capex and minus 1% for non-capex. You know what lays in store for you over the next few years if the same government were to come back. And I think that was a very, very important messaging from my perspective. We have been, quite positive and quite optimistic on the whole capex cycle to start with. And this budget really comes across, as a music, in that context.
Mahesh, hi, morning. That also sort of somewhere reflects that the government has confidence in re-election come May, right? And that's purely a big cue for equity market watchers.
Absolutely. I think there was generally there is still and there was the consensus expectation, around the political continuity, but that was the market expectations. And I think with the budget that was presented yesterday, the government has endorsed, that market view, I would say.
What's your stand as far as the capex number is concerned? Though, some see it that last 4-5 years, the run rate was anywhere between 30% on average. This time 11% appeared slow. But the other camp is that the base in the lows last 4-5 years or the peak of COVID lows has actually expanded a lot. So even 11% is a very healthy sum, or record high 11 lakh crore thereabout. How meaningful does it appear to you? And do you think it's also an indication to corporate India that it's about time that you may also want to loosen your purse strings towards capex?
Yeah, actually, just to, be sort of correct on the numbers, it's actually not 11%, it's actually 17%. With that 11% is from BE to BE. But if you look at the revised numbers that have come up for FY24, from those revised numbers, it's actually 17% up. So the capex growth is not 11%, it's actually 17%. So just to be correct on the numbers, I think that's a very meaningful number because as you, mentioned, while over the last 4 years or so, we've been seeing a 25 or 30% kind of a growth. But that was on the relatively lower numbers, but now on a higher base, and we are looking at a 17% growth. I think that's a meaningful number. And mind you, we're also looking at this number in the context of fiscal deficit, actually going down by sort of budgeted to go down by 80 basis points. And in that context, the 17% growth number looks very attractive to me. And as I said, it's not just this budget. I would actually extrapolate this strategy of the government over the next 5 years, if one assumes that the same government will be coming back. And I think it's a clear message that it's the investment cycle which the government wants to encourage. It's the broader investment through infrastructure and in manufacturing, so on, is what the government wants to encourage. And I think the equity market investors clearly need to take cognizance of that.
So, from an equity standpoint, Mahesh, where do you think this year is headed? While, of course, the market is doing what it's doing, but FIIs continue to elude us. You've got two big events, both the US elections as well as our very own elections. You've got another budget as well lined up. And then, this is in the backdrop of all the geopolitical tensions which are, continuing to spiral up.
Yeah, so, I would say that so over a period of time, we've realized that we've got a very strong set of domestic investors, as a large, asset class, which has now been supporting the markets. I agree with you that over the last couple of years in general, we've not really seen meaningful inflows of, from the foreign investors. But, I still continue to believe that this year will be the year when the dollar peaks out and there will be rate cuts by the Fed. And I know that the expectations around the Fed rate cut keep on changing. I mean, we started the year with almost 150 basis points, and now we're talking about a number slightly lower than that. In the recent communication, the Fed seems to be giving a message that we should be lowering the expectation of a rate cut in the March 24. So there are some things like that. So some changes might happen here and there, but still the central messaging is that whether it is 150, whether it is 125 or 100 or something, there are going to be rate cuts in the US. And I clearly believe that that will mark the peak of the US dollar and would be an excellent environment for emerging market as an asset class to do well. So I still continue to expect meaningful FI flows this year. I mean, last year we got about $20 billion, but according to me, that's a very, very small number. And I'll not be surprised if we actually see inflows from the foreigners, which will be a multiple, of that number. That still, is my base case. So yes, the markets have moved up, but if I go with the the current investor positioning of foreign investors in India, I think is very, very light. And in the context of this expected weakening of the US dollar, I do expect strong foreign flows, and I don't see any reason why the domestic flows should weaken. So my sense is that we are still looking at a decent 12% plus kind of returns for the broader market, and obviously some sectors, especially gearing towards the capex, some interest rate sensitives, will actually do much better.
Mahesh, I see that you are incrementally negative on rural side of the plays. Whereas, an observation yesterday, day before actually, was the commentary from Godrej as well as Dabur seem to be suggesting early green shoots in that zone. Now this entire, part of the market which is sensitive to volume growth and margin, etc., got hit by inflation issues. Does it think that worst is priced in there? Or you think it could be longer and street is perhaps becoming impatient and getting in these kind of names?
So selective names will definitely do well. But when we talk about underperformance, or when we talk about the street is not acknowledging these numbers, I think we have to look at a slightly more historical context and not just limit ourselves to what has happened in the last 1 year. We have to look at the starting point 10, 12 years ago in 2010, 12, that many of these consumer stocks were trading at 20 times, 22 times 1 year forward earnings. They went all the way up to like 60, 70 times, and we've seen some valuations correction towards 50 times multiple or thereabouts. So yes, there will be a bottoming out of the rural economy, because if you're looking at a positive outlook for the capex sector, the construction sector, it's ultimately the rural laborers that would be seeing the ultimate benefit of it. So I have no doubts in my mind that the rural economy will bottom out at some point in time. But the re-rating that we've seen in many of these names over the last 10 years, going up from 20 times to like 70 times, I think that needs to kind of retrace, especially because one large segment of the market, which is all these like capex related sectors, which was completely ignored by the investors for the last decade, is now coming back into focus. So there is going to be some continuous allocation of monies away from expensive consumer names to some of these capex and real estate and other interest rate sensitive sectors. So that, I think, is a much longer term theme that we have to keep in mind. So in that context, yes, while the rural sector will bottom out, I would still be more optimistic on the cyclical side of the stock markets.
Oh, Mahesh, great to have you in the show. Glad that you could make time and join in as always.
Thank you very much.